If you're watching CNBC or Bloomberg and you see these really smart people come on and smug, and they tell you that, interest rates are going to get cut, 4 more times in 2025, and, they're super smart and whatever, and they start talking about 5-year forwards, don't believe them. They have no idea. We've got a power crisis that's developing.
Yep.
If President-elect Trump follows through on his threats about 60% tariffs on China or 20% tariffs across the board, that'll be disruptive.
You've worked at these levels, right? You've worked with the Trump administration and everything else. What is your outlook on their plan? What do you think is going to be their priorities? And what are they going to roll out first? What will be the quickest things they can get done? And then what impact will that have literally next year? Welcome, everybody, to the AJ Osborne podcast. And today I'm so excited. I've got Andy here with me. He is an economist, a futurist, a consultant. He has been doing this for a long, long time, and he is extraordinarily well informed. For a lot of you guys, if you have seen his past work videos, including his keynote that he's delivered, we were very, very impressed. And Andy, thanks for coming on here. I have so many questions that I've been dying to talk to you about, and I know our audience is very excited to hear from you. So thank you for your time. I appreciate it.
Sure, AJ. There's a lot going on in this world, and commercial real estate has been whipsawed by a lot of it. So it's a great time to talk about it, especially since it's been recovering. And that's the best news, right? To just level set everybody right away. And it will continue to do so going forward.
Wonderful. Real quick, why don't you give, for those that don't know you, why don't you give a quick background, and then we can jump into the discussion here. But why don't you tell people about your background as an economist and, why you do this?
Yeah, so I've got an interesting career, very different from most people that are in this space. I mean, I traded currencies for almost 20 years. And so that is your most applied economics learning curve that you can possibly imagine. And one of my strengths was, of course, having an MBA from University of Chicago and a background in economics, I immediately could read the news and understand and understood what it would do to the markets. So I made a lot of money for the investment bank that I worked for and myself doing that. Then I transitioned out of trading into writing a lot of research for clients and doing a lot of meetings with them, explaining what was going on in the world. So I did that up until 2013, left and went on my own. Then I had this crazy opportunity in 2017 to join the Trump administration. I know people are probably blanched at that, but
that's amazing.
The opportunity was amazing. I was the nation's first chief market intelligence officer at an agency that most people have never heard of, the CFTC. But I had a team of 40 researchers covering the markets, the economy. We created research, and our job was to, send that out to the public, but also I did presentations for the White House, U.S. Treasury, Federal Reserve Board, SEC, CFTC, and so on. And I also acted as a liaison for the agency that I worked for. And that means I got to meet with hedge funds, high frequency trading firms, all of that. So I did that up until 2019. Then I left and restarted my consulting company. I've been doing that ever since. And it's really been a blast. One of the things that was really fun to do was back in 2007, I wrote a book called World Event Trading. And I always like to tell audiences, this is my big secret. No one read this book. I mean, nobody. It came out during the global financial crisis and, it just got shunted aside. But the concepts of the book were pretty good. The first 5 chapters, this is 2007, the first 5 chapters were on infectious disease outbreak and their impact on the economy and the markets. The next chapters were on short-term war. The next chapters were on disputed elections. And the next chapters were on big climate events like hurricanes. That's why I call myself an economic futurist.
So you wrote the playbook for the next 15 years.
Basically, yes. And you know what's crazy, AJ? They all came together at the same time. So that's part of why my consultancy has kind of exploded in growth. And so a lot of people need help kind of navigating what's been going on really strongly since 2020, obviously. But that's a little bit of background on myself.
I love it. I have so much we want to talk about and go into here. This is such an important time for individuals like you to be speaking to people because they are confused, right? And there's so much noise and so much going on. And sometimes I like to tell people that I feel like we can lose the plot within the noise, right? Like we literally kind of lose what's really important and what it means and how markets function and work within all the noise. And that's why I love having discussions with people like you, where it's like, hey, what does this mean? And come back to, the whole main event here and what's happening and what's going on. Now, you have a bunch of key points when you look at, how you're going to understand not only the present, but the future. And you have them laid out like really nice. How you look at the past, the present, future. And I'd like to think of things as drivers. So like, what are the drivers that make things happen? Not that you predict the future, but understanding what is happening and the cause and effect of those. And commercial real estate, as well as real estate in general, is a perfect example of it because it's primarily very sensitive to those macroeconomic changes in relationship to government, currency, and debt. And you were right in the middle of when this was all changing. So why don't we talk first about the real estate industry? Then I want to go into more of these world events, tariffs, and what's going on with that. So, because you literally wrote the playbook on it. So let's first talk about the real estate industry, because that's been, out of everything, I feel like that's been jolted the most in the last, 3-4 years. So walk me through what happened with interest rates. What did we see? Why did interest rates go up? Are they coming down? And how that's affected the landscape so much?
Yeah, I mean, obviously, commercial real estate is still being impacted by COVID. And let me just level set. Hey, anybody who wants the research, just go to andrewbusch.com. It's all free there, just so you know.
And it's amazing too, by the way. Like really, the information you put out, the videos, the site, it's simple, it's clear, really helpful.
Yeah, and we just put something out on AI in construction, engineering, and commercial real estate.
I got to check that out because I build technology in the commercial real estate space, and especially AI, we integrate for mass data analytics to understand. So I'm going to have to check that out because that's my thing.
Yeah, I do, for sure. But getting back to your question, I mean, this is the thing that I try to help audiences with a lot. And my big thing, of course, is context. In other words, if you don't know where you've been, you certainly can't figure out where you are, and you'll never see where you're going. So don't research that gets produced that doesn't have that drives me crazy. And whether it's research or whether it's anything, if they just jump right into stuff, it doesn't make any sense because you don't know where it's been. And so is a 15% increase a big deal or not? I mean, that's kind of the thing that drives me crazy. So if we go back to COVID, we shut down the U.S. economy and we really changed the dynamic of especially the commercial real estate office. And to some extent, we jacked up commercial real estate industrial without question.
Yeah.
Because if you force people to stay at home, well, we created a supply chain nightmare to some extent. It really broke the global supply chain back, in 20 and 21. Because, you're forced to stay at home. You got to get a new chair. You got to get a new desk. Junior needs an iPad to go to school. All of those things are goods, right? And so the U.S. economy is based upon consumer spending. I mean, and 70% of that is spent on services. 30% is spent on goods. If you change that just 5% like we did during COVID, well, you break the global supply chain. Nobody could get what they wanted when they wanted it, including chips. And so just as an example of that, container ship costs for one container went from $2,000 to $20,000. Okay. So all of that sloshes through. So we have COVID, then we have the outbreak of the war, and then we have inflation, right? So we had this big surge in inflation in goods, and then it translated or moved over into, the services sector. Anybody who knows how grocery stores work, right? Once you jack up the price of energy, you've got last mile, you've got diesel, and then all of a sudden grocery prices go up. So that's kind of the nature of what the central bank's been dealing with. They made a lot of mistakes back in 21 to 22 when we had this just massive amount of stimulus come from the federal government. It was about $14 trillion worth of stimulus. And the Fed just sat there and said, we're not worried about this inflation that's getting, jacked up here. It's just in the goods sector. It's in supply chain. But we had so much, 14 trillion on top of 0% interest rates, 5% economic growth. And then we had the outbreak of the Ukraine war. So then, inflation got crazy up to 9%. Finally, the Fed acted, right? And so then they raised interest rates aggressively, 525 basis points in 14 months, kept it there for 14 months. And they engaged in quantitative tightening as well, which is basically just dumping the securities that they bought to flatten the yield curve down. And so that's kind of where we're at. And as we've gotten into 2024, inflation is eased now. It's, down somewhere between 2.5% and 3%. The goal for the Fed is somewhere around 2%, depending on which target you want to look at. Some of their targets they've hit it. Some other ones, not so much. But that's why they cut interest rates. To me, they made a mistake already, which is that they cut 50 basis points right away. And then they cut another 25. 50 basis points is an emergency move. I don't know what they were thinking on that one. But what's interesting to me, of course, AJ, with this is how the markets price in and out things. So if you're watching CNBC or Bloomberg and you see these really smart people come on and smug, and they tell you that, interest rates are going to get cut, 4 more times in 2025. And, they're super smart and whatever. And they start talking about 5-year forwards. Don't believe them. They have no idea. I mean, I've operated at the highest levels of government. I've talked to a lot of these people. You know how they figure out where they think the Fed's going to go? This is what they do.
Absolutely. And they're wrong.
Yeah.
Pretty much every time.
And they hit 6 rate cuts at the beginning of 2024. We've only got 3, but next year they're pricing in 4, but maybe 2 front loaded in the, first half. I don't know. But what I would say is this: when it comes to interest rates, the Fed is going to be likely a little slower than most people want for them to cut rates. Because honestly, there's no rush to do this. The unemployment's at 4%, GDP's at 2.5%. That's great. And, inflation is slowly coming down. There's no rush to be aggressive on interest rates.
In fact, there's more of a danger.
Yeah.
There's more of a danger that inflation will kick back up. And so they don't have a driving reason. And that's because there's so much money. We haven't gone through a contraction, so we haven't eliminated the money supply. And so when you look at it and people are like, oh, they're just going to start bringing it down. I always ask why? Why would they? Exactly. What is the driving reason outside people want it? Because they want lower interest rates. And that is where I start to really find a hard time. And we've been saying this since a long time ago. We haven't lost any money. It's like there's no defaults. We're not contracting. We don't have job loss. Spending's not down. So then why are they doing it?
There's no soft landing. There's no landing. We're just growing. Yes. And we're going to continue to grow going forward. But that's a great way of putting it. I really like the way you phrase that.
Yeah. This effect is so too, even the concentratedness amongst real estate, and you look at it, but housing prices aren't going down. So we're not having the opportunity for buying a new house, everything that's been stifled, but people aren't losing their homes. They don't have to, there's not a driving reason outside. Yeah, you may have to wait a few more years till you can afford a home with a given interest rate or whatever that may be. It's obviously a focus area, but that's not causing economic problems on a mass scale. So when we look at it and we go, the Fed driving here and trying to get Main Street done, they react to markets. So the markets have to give them a reason why to do certain things. In 2008, the money supply shrunk, obviously. So we had a hole they had to fill in. There's no hole to fill in. In fact, it was the opposite, like you mentioned. Money supply had been growing due to low interest rates and a booming economy. So they're in a tough spot. And when you look at that, do you think that they need this? Do you think that the Fed will continue tightening until we have pain, so then they can reduce interest rates? Because recessions are obviously normal and needed. And so how does the government look at that? What is their priority here when the Fed is looking at it, when our government, though, is still printing and injecting trillions of dollars? Every 100 days, we're going $1 trillion, right? So there's money supply still coming in. It just may not be from the economy, but how are they balancing this?
Well, I would say for the Federal Reserve, and you pointed out a really good point early in what you were just saying, and that housing prices have gone up and they've not come down. Mortgage rates have bopped around quite a bit. They were up at 8%, then they dropped down. Now they're back around 7%. The thing is that if you look at home prices across the country in the 10 major cities, they're just not coming off. And so what's happened is, again, context is king here. What happened after the global financial crisis? We underbuilt by about 500,000 homes per year for about 14 years. Like, we're not going to just flip a switch and solve this. It doesn't work that way. It's going to take quite a bit of building to get that done at certain price points.
And with high interest rates, the building slowed.
Right. And so there's not as huge wind at everybody's back to build like there was in, 2000 through 2007, where interest rates were, they were low, but they were going up. But, 0% interest rates cure a lot of ills, but they create a lot of problems if you don't manage it. And that's what we've seen. I would say also, getting back into commercial real estate, again, context wise, we learned a lot from COVID. Now, having written this book way back when, what I will tell you is that historically, when there's an outbreak of disease, it's really consistent what happens, right? The outbreak occurs in a city for sure, because that's where more people are, they're interacting and so on. The next thing that happens is that people try to leave that city and spread it all over the place, right?
Yep.
Sadly, that's the case. But the next thing that happens generally is that people move back into the city because that's where the action is. The difference this time is technology, because we've learned that we can work from home efficiently. It doesn't always produce what we want, but it produces a lot of what we want as far as being able to do business. Now, there's a lot of downsides, especially for younger workers. They don't get mentored. They don't get to see the daily interaction in the office. They don't get to overhear things. They don't get to see older colleagues working with clients, how they interact with them. As a matter of fact, I would say that's a real drawback. I've seen it time and time again, where younger workers think that they can just send an email and that solves the problem. And then you ask them, well, what happened after the email? They say, well, I don't know. They didn't respond. It's like, no, pick up the phone and call them or make a meeting, right? It doesn't register. Why is that happening? Because this is what they grew up with.
Yeah.
And human beings need to interact. So, but getting back to commercial real estate. So what did we see? Obviously, we had major donut holes in all of the major cities in the north primarily. And we're still not up to the rates of people going into the office that we had previously. If you look at Castle swipe rates, they're still about average 50% for the country. One of the things that I always like to look at, of course, is the public markets, looking at REITs and ETFs. And those cratered for quite some time until, recently, but they have recovered. For New York, as an example, the one for New York is Slug, SLG, right? That thing was down 80% at one point. And so you kind of have to laugh about that and say, oh my gosh, I wish I had bought it then, because now it's only down around 20%. But that's a good taste of what's happening in that space overall and how work from home has negatively impacted a lot of the commercial real estate that's out there. Office, right? Not necessarily industrial. Industrial's done okay overall, I would say. Wouldn't you agree, AJ?
Yeah, absolutely. Industrial, we have, a few asset classes. Storage had a big contraction, but the large margins allowed it to survive well. And when you look at industrial, the supply chain problems, but also the work from home or office, people getting out of the office and people starting up businesses from online, and you had these side hustles, everything else created a lot of demand, even for light flex space, smaller flex space, which they weren't building. They were building to the big companies. So there was huge holes and gaps within the markets anyways. And storage had been kind of overbuilt, but then the homes, right, stalled. That's actually the bad thing for that part of the industrial space, was that you don't mind it if home prices fall because people have to move or they go up, but you can't have it not move. And so that hit the storage space really hard because 43% of their business come from transaction from people moving. So you had these, it was kind of this weird shift, but everybody was moving towards those asset classes out of office. They were moving out of the hotel space, right? And then COVID brought on the high restrictions of multifamily. And so people started to key in on things like storage and really overbuilt. And the industrial was interesting, I think, too, because of where it happened. The supply chain problems in last mile, particularly in cities that were fast growing second tier markets, had huge contractions with people moving there from other cities, moving their businesses there and not having anywhere to go. That really drove up prices in second tier markets as even business contractors, things like that, were fleeing the big cities. So it was fascinating how those two during COVID blew up. Storage blew up, industrial blew up because of the demand. Then storage got hit really hard in 2023. Industrial, they're still trying to keep up with and still trying to keep in. The supply chain problems didn't go away. But comparative to the other asset classes, they did much better and drew huge investor interest.
Yeah, so some interesting things. So the Census Bureau did something, I'm going to use two words about them that you probably never heard before. The Census Bureau did something really cool. Now,
yeah, that's something I would never have heard.
You would never have thought about that. No. But it's a little creepy, too. They studied the internal migratory patterns of U.S. citizens between the summer of 2020 and the summer of 23. We're going to get the next year in the end of this end of December. But what they saw was a real migration out of the north to the south, out of California to places like Arizona, Texas, North Carolina, South Carolina, and Florida. Big time. So you had that happening. So those cities lost, and those states lost population. But at the same time, you also had, under the CHIPS Act, you encouraged a lot of companies to build facilities, right? And some of that was in Ohio, but a lot of it was in the South. EVs, especially in the South. So from an industrial standpoint, there was a lot of growth there. And then, of course, you had the explosion in data centers. And that's obviously related to AI. And those things they've just grown massively. Now, obviously, those are not big projects, but they are prolific in how many they are and will continue to grow. I always ask audiences like, hey, just, does anybody know how many of these things are in the United States right now? And the next largest country is Germany at 600, right? And you get guesses of like 1,500, 1,000. There's almost 6,000 data centers in the United States. Germany's the next highest at 600. So in other words, we're going to be rocking and rolling. We're going to be at the top of AI for a long period of time because of that. But then you start cascading down of things from the data centers like power generation. We need a lot more electricity. And so then, talking about building out that capability.
Which is problematic in the United States.
Oh, yeah. I mean, NIMBY is a huge problem. You just cannot get stuff built. So then how do you get around it? That gets into permitting. That gets into the Trump administration because it's likely they'll come up with something, I hope.
Are they going to push nuclear? I know there was some talks and discussions about that. I mean, this isn't light switch stuff, right? You start to plan and you don't see the yield from it for a long time. Yeah. But one of the problems with energy is the infrastructure overall. So we can get so far behind because infrastructure isn't built out. So you can so dramatically outpace, demand can outpace supply in those kind of sectors. And with the government in so much control of it, that it actually makes it very slow, and every state is different, which that also creates some problematic with the infrastructure. So you think this will be a growing problem for the United States? It is one of our thesis when we look at energy and supply chain. We did a $40 million project in Surprise, Arizona, because we viewed the supply chains of Southern California that were strained, couldn't do it. They were moving over to Arizona because you could get from Surprise, a suburb of Phoenix, to the coast in a day and everywhere else. And they got the $40 billion to build the chip plants. And one of the big issues we were looking there, obviously water, but the overall power usage. And we felt that Arizona was better than a lot of places, though, so that could continue to grow. But how is this going to become a much bigger issue in the next 10 years because it's growing at such a rapid pace?
I don't think it's the next 10 years. I think it's the next 2 years. We've got a power crisis that's developing.
Yep.
I mean, if you talk to any rural producer, they'll tell you that if a data center moves in, it's their number one client within like a factor of 5 really quickly. So that's where we get into thinking some longer term issues about rationing energy, because that's really what these companies need to start to think about, especially the co-ops. They'll start to think about it. Not to get too far off topic, but do you want a data center which is a big client, but it only employs maybe 10 or 20 people. I don't know, building it out more than that, as opposed to, like a chips factory or any other manufacturing that's being encouraged to move back to the United States, which could employ 500 to, 10,000 people.
You employ 20 people, but you use the power of a company that would employ thousands, because it's so power intense due to the fact that it not only the servers everything, but it has to keep them cool, and you got all of these issues with them. So it is skewed, right, on the economic output for the local community versus the resources it's taking.
Right. And so one of the things too with data centers, of course, they need cooling. So that means you're talking about HVAC. So that means you're talking about a lot of people making a lot of money that employs a lot of people. Yep. So it's not just in the data center. And that is a really great point. I'm down in North Carolina and they've got a few of these things coming in and they're just like the HVAC is crazy. Of course, North Carolina is unusual because it still has really cheap land and home prices are relatively inexpensive. And the personal taxes here and corporate taxes are pretty reasonable here as opposed to California or Chicago or Illinois or New York. So, the amount of people that are moving here is generating demand and creating job opportunities in those spaces.
And this is the driving when we do look at real estate and especially commercial, because it's so hyper local. This is where we see a disparity. Like, I think when you look at commercial real estate, interest rates affect the asset trading as a whole, right? So the actual market value and the buyers and seller pools, that gets all skewed with high interest rates due to the cost of money. But the local part or the intrinsic value of them, the actual demand and what they can get from a yield as far as whatever it is off of anything else that they're doing, that disparity is astronomical across the nation. So commercial real estate in an area like you're talking about versus a rural area in the Northeast or something else, or in a part that doesn't have growth, it is so wildly different, the performance of these assets. And we don't see that almost like that balancing act due to interest rates. You see a overall compression or strain on the buying, selling, refinancing, but the actual, like how much money you can get from it, that is very localized. And so some can outpace their growth from what they can charge everything else because there's growth. They can refinance, they can actually get through those. But other places where there's not growth, they can't lift up prices. They can't do things. So they are really dependent on low interest rates because they're not going to get those things. What should people be thinking about now looking forward with interest rates and an effect of commercial real estate and real estate in general, given where we're at? The Fed's announcing that they started and they're going to lower rates, but as we know, we don't have a complete crystal ball. What should investors be looking at or expecting with this kind of landscape?
Yeah, so it's going to be a slowly improving landscape when it comes to commercial real estate, I think. In the major cities, you're going to see a large increase in conversions next year from office to residential. Properties have fallen so much in value that you can convert and make money from it. So that's good news.
We do that. We do that. We've bought office buildings and converted them over. And we used to do it with like a big box retail, things like that. So yeah, I think that's a major trend that will continue where applicable or available.
Yeah, it's all about the price, right? Yeah. I was in Dallas giving a talk last year, and I met with all the big developers down there, and I was asking them, like, hey, those conversions, those things are expensive. Like, how's that going to work out? Because the layout of an office is very different, piping wise and all that. And they said, well, Andy, it all depends on the price you get for the property, right? Because then you can make it worthwhile. So I would say for office, that's going to be a continued problem. Interest rates are going to come down slowly. I think the unknown is what is going to happen under the Trump administration. How quickly will they move on, some of the tax laws that they're going to change? The corporate tax rates, they're looking to bring those down from 21 down to about 16 or 15%. Tariffs are going to be another issue. Obviously, if President-elect Trump follows through on his threats about 60% tariffs on China or 20% tariffs across the board, that'll be disruptive.
Yeah.
It won't hurt the United States as much as it'll hurt our trade partners. but it'll create a one-time bump to inflation. And basically, tariffs are just sand in the gears of the global economy. Now, there's reasons why I think, not to get into deeply, but
let's do, because this is a big factor. So I don't care what industry, we got to get steel, right? So we have to get steel, we have to get wood, we have all these other countries where the majority of this stuff is produced elsewhere. Not that affects real estate, that affects markets, right? We have the chips in Taiwan. They're trying to bring all that kind of stuff back. So there is no difference between the global economy and the United States economy. They're one. Like it doesn't work like that. We just can't cut them out because we can't build. So when we're looking at that, you've worked at these levels, right? You've worked with the Trump administration and everything else. What is your outlook on their plan? What do you think is their priorities? And two, this is really important. Some of the stuff they talk about, right? They have way more power to get done quicker. But other stuff that they talk about, it doesn't mean they can just walk in and do it.
Right.
Some of these things they have to get, 60 supermajority of Senate to agree upon, where they only have 53 Republican seats. So some of those things you go, maybe they can, maybe they can't. What do you think is going to be their priorities, and what are they going to roll out first? What will be the quickest things they can get done? And then what impact will that have literally next year?
Right. So the first thing is the president has broad authority when it comes to trade. Those things he can do pretty much day one. And he has the legal authority to do a lot of it, depending on how he frames it. Some of it will be brought up in lawsuits against. It depends on how big and broad they go and the reasons that he provides. But those lawsuits do take time to work their way through. They'll still be impactful. It has been in the past with the Trump administration to negotiate through that use of tariffs. So that's the first thing. Taxes, that's a function of you don't need to have the Senate with the filibuster. You can do tax reform under what we call budget reconciliation between the two houses of Congress. So in the House, just majority, but in the Senate, you can do majority rule as well, 50 votes. So that could get done relatively quickly. And again, as far as markets go, just remember that, as we're thinking back to the first Trump administration, it was the anticipation of the Tax Cuts and Jobs Act, the TCJA, that was done in 2018. It was the anticipation of that. Go back and take a look at the stock market and what it did in 2017. It almost had no pullback. So if you think that stocks are overvalued now, go back and take a look at what was going on in 2017. Every day that thing went up with less than like a 1 or 2% pullback. It was crazy. So it's always anticipatory in the way that they look. So that's something that I think would be next in line. The third thing that would be really, really beneficial that does take more time, of course, is deregulation. And that will be, that's clearly a main thrust of the nominees that he's put forward. They're unusual to say the least. But that's what I believe my understanding is of the people that he's bringing in. They really do want to disrupt government in the sense of changing the trajectory of where it's been going. That's a harder lift for sure, but it's really important. That's something that happened during his first administration that very few people talked about. We did a lot of financial deregulation, which was great. Sarbanes-Oxley, all the other things, they've been there for so long that we finally came through and changed a bunch of things. So that was good overall. So just those three things, that's kind of the sequence of how they'll play out.
So on this point, this is like obviously a big issue for lots of businesses, things like that. But the question that I've been going, people talk about inflation, what's going on. For me, to offset, they want, because if you get growth, let's say deregulation, you get all these things happening, lower interest rates, growth, that creates inflation on already top of a problem. And as I understand it, trying to read through what they're trying to do is basically a swap. So right now, whatever it was, 50% of all new jobs created were from the government. 40% of the GDP was from the government. They're printing, trillions of dollars every quarter. And so how I look at it is they're trying to basically ease off out of the economy, the government effect, and drive in the Main Street effect. So switch it from government, as I call it, government economics to actual economy, and trying to do a balancing act here. Whereas you can have the economy grow if you're pulling back money that the government's spending, and you can have job losses in the government if you have job creation in the economy. And it's a balancing act. What you can't have is you can't have spending trillions of dollars, the government hiring all these new hires and growing like crazy, the Main Street market doing the same and not have inflation. So I think a lot of people are going, how do you have the economy boom and not have inflation at this point when the money supply is astronomical? I mean, basically we don't have inflation because transactions, things like that have slowed down. So the velocity of money is like really, really slow right now, but it's still sensitive. I mean, we saw inflation tick up a year ago when they even threatened, when they said, we're going to lower interest rates. The next quarter, inflation went up. It was like, just even the hint at it. So this balancing act that I see, there are three initiatives. That's what it's part of. Like, you can't do one without the other. Where am I wrong on this? And what is my thinking here flawed? Because that's how I'm understanding it. But I could be wrong on that completely.
Yeah, the public sector really hasn't created that many jobs. I mean, if you're talking about the federal government, I mean, the number of jobs there has been pretty steady over time. I mean, it really hasn't grown that much.
They have more employees than 34 states do in their private sector.
Well, they are the largest employer, obviously in the country. But I mean, that includes the Defense Department. So we want that.
We want that. Yeah.
Where I think there's a lot of growth potential is in reducing regulations and reducing the regulatory burden that we've experienced in the Biden administration. They've cost American businesses, it's estimated, there's a really nice group called the American Action Forum, but they estimate it to be, since Biden took office, of $1.5 trillion.
What's that group called?
American Action Forum. Okay. It's run by a guy named Douglas Holtz-Eakin, who used to be a CBO director. And I got a chance to work with Doug during the McCain campaign. That was a lot of fun. But Doug's a really sharp guy. They do something called regulatory rodeo, which just shows you how many regulations are hitting. Like, I think it's every week, but they total them up. And when I travel around the country, AJ, I talk to groups across the entire sector of the economy. I just don't focus on commercial real estate or construction or any of that. It's chemicals, it's energy, it's you name it. And so it's really nice because I get a very different perspective than most people. And because of the consultancy, we actually get into the people's businesses and we ask them some pretty basic questions, but are really telling. And one of the questions we ask people is like, what are your top challenges? And the number one or number two out of every single client we have is regulations and the uncertainty around those.
Yeah.
And so that's one of the hopes that I think most American businesses were pointing to a new Trump administration coming in and that they would reduce those. Now, whatever you think about Trump, that's, put your, partisan goggles aside for a moment and just try to think of growth opportunities. But that's where I think there's some big benefits that could come. We talked about energy, and permitting is a big deal, getting energy across state lines, or getting, if you can get windmills in Texas, which, believe it or not, they have the most, I believe, in the country, and be able to take that and send it up to Illinois, to Chicago. Hey, you got something going on there, and you really encourage the creation of those windmills without government intervention. You're letting animal spirits loose. And that's really what tax cuts too are all about. So that's, I think, what's really encouraging about what's coming up.
And I think it's really important when we talk about regulation, a lot of people go, oh, that's big business. That's actually not true. No. Regulations hurt small business. They actually help big businesses because they move up the barriers of entry.
Yes, they do.
And that's why most regulations are actually in coordination with corporations. So the regulations, and they're getting input from the largest companies in the world on what regulations and how to do them. Like the banking acts that we have, right? Well, who in the world is making the decisions on who to regulate the banks? It's ex-bankers and bankers. And so when you look at this, regulations are built by big business and they help them because it's so disproportionate. Regulations impact at a rate that it's a multiple above, right? The big corporations. So when I think a lot of people hear deregulation, they think big business. And that is wildly not true. Regulations put small businesses out of business, and they give all that business to the corporations who can have the size and the volume. They have attorneys, everything else like that. So the impact of those costs is a fraction of what it is to small business.
Yeah, and I really liked how you framed that and calling it a barrier to entry, which I think is a really good point, because one of the great things about our country is the facility or the ease of which you can start a company. And that's great. But as soon as you start lobbing in all these costs onto companies, whether it's OSHA, whether it's, you name it, reporting standards for your energy or pollution, things like that. I mean, some of these things we want for sure.
Yeah.
And those are decisions that we make, but they also come at a cost in the sense, not only dollar wise, but it also shuts people out. So I think that's really one of the greatest opportunities.
Can they get it done? Like, a lot of people think they're just going to come in and gut the government, right? That's not how it works. So walk us through that. Can they get it done? And what do they have to do? The Department of Education is a perfect one. Let's say that they get in and they're like, we're going to just eradicate it. Can they even do that? Or what is the process for them to try to either cut out government agencies, cut the budgeting, change the employment, actually let people go, cut deregulation, actually get rid of regulation? How does that even work? Can they just wave a magic wand? Can Trump just say, you're fired? Like,
it doesn't work that way. No, it has to happen at a couple of different levels. You bring in new leaders and they set the agenda for that agency or that department, like the Treasury Department or whatever. And then through that, you can take a look at where they're going to spend money. They create their own budget, and they have budget priorities. One of the complicating factors to a lot of this is, of course, unions, and the government is heavily unionized. So it really becomes challenging you can't just fire a bunch of people because you'll be sued for that. But one of the things that they could really, and this is something that I wish we could do in education overall, is to reward the top producers. When you have unions, they don't want you to do that. They want everybody to receive the same amount at the same rate, and you lose your top people going in there. If you could change that dynamic, that would help significantly. I think they'd have to work really closely with the unions and the way that they look at the world. The way that they could do it is by attrition and not rehiring anybody who leaves. They could do, payout packages to get people to leave faster. That could happen for sure.
Could they just starve the beast? Like, literally, could they just have Congress pass a law that says, all right, Department of Education, you guys get $1 million next year. Figure out what you want to do with it.
No, Congress doesn't have to pass that. I mean, the head of the agency or the head of the department says, you know what? We don't need $100 million. We only need 50.
Got it.
So I think that is the best way of approaching it. Now, it depends. There's certain really important functions that we want to fund, obviously.
Absolutely.
For all the problems that we have with the FDA, obviously there's listeria outbreaks we want to stay on top of. The Defense Department, that is an area we definitely want. But I think already with DOGE, with Musk and Vivek already looking at, as an example, the NIH, they found that the NIH spent something like $2 million on shoes for people in Africa. Now, I'm sure their hearts were in the right place, but when you look at something under the surface, you're like, what in the world were they doing? Why did they spend that money? And that's another weird thing about the budgeting process. Like, if you have money that's coming up and you haven't spent it, and this is the mindset of people too in government, it's like, oh my gosh, if we don't spend this money,
we won't get it again.
People that have oversight of us for next year are going to go, you have excess money, we're not going to give you as much. And then they try to rush it out the door.
Use it or lose it. So they just spend it because they don't want to lose it.
Right. Well, they just want to get the funding the same level for next year, whatever that is. But, that's part of the issue. So as crazy as it sounds, I love the fact that they're trying to do something along these lines.
Me too.
And just taking a step back from this, and I know we're running out of time, but the thing that I think is really important for people to looking at the 2024 election is to understand that most Americans, their interaction with federal government has been very dissatisfying in the sense that it's way too complicated now. And you just leave with a bad sense that it's not working for you. And at this time of year, everybody gets bombarded by these Medicare commercials and re-signing up for Medicare. That's a great example of the complexity of what's going on with government, instead of making it simple for people like, hey, just sign on the dot. This is what you get. Now you have all these different programs that you actually need to hire somebody for to tell you what to do.
Yes.
Everybody's like, well, I hate the federal government. It's not helping me. They don't see the good things that the federal government can do. And it's because of that. So I think overall, that's part of why Trump won, is that
I agree.
The voters and the majority of the voters want a redefinition of that interaction between themselves and government. They want to feel like it works for them instead of the other way around.
Well, since the 70s, right, they really changed a lot in government law, and they really deferred power to these agencies for, creating and regulating and everything else. And so the disconnect from people, from elected officials to what happens on the ground is astronomical in a way that it was actually never designed that way. So the government became something that we don't feel we have input in, because we don't. Like, the elected officials don't even understand what's going on. They're just giving money out, and then people are regulating and they are enforcing, and the elected officials have very little input, and people are feeling that. They feel like, I vote somebody in, it doesn't matter. Like, a lot of people felt this way with Barack Obama. Yeah. We want change. And they did it. They got him in. They're like, we're going to change this whole thing, right? And it got done and nothing happened. Not only nothing happened, everybody's like, we're not better off. And we gave you 8 years, and yet it still works the same.
Well, they passed Obamacare for sure. They created a massive amount of spending from that side.
And the complexity of it is crazy.
Right. But the best news is what's happened. You described what was happened prior to the Supreme Court ruling on Chevron. So the Chevron defense usage meant that Congress wrote laws that were kind of broad, and they left it up to these agencies to interpret them. Finally, the Supreme Court said, you know what, Congress, you're not doing your job. That's, and so what does that mean for the average person? Well, it means that you're going to get a lot of lawsuits challenging what these agencies do. And that's really, to some extent, is good news, because then they'll likely make better policy that makes more sense, instead of just having these, like waters of the U.S. rule. I don't want to get too far into some of this stuff, but like, if there was a pond that was adjacent to a property, not even that, like just where water was collecting, you might not have been able to farm or do what you want to do with your land because of that adjacent water puddle. I mean, there's crazy stuff like that out there. And that's where, we really want to get away from. And that's where I think, again, looking to 2025 and beyond, there's going to be some very good growth opportunities over the next 2 years.
Well, okay, we've taken a lot of your time, and I really do appreciate it. This is very insightful. And I know our listeners, they appreciate the clarity coming from somebody that's done it. This isn't just me saying, oh, I like it. This is somebody that was in it, the thick of it. They do it. They've seen the data. You know what you're talking about. Where can people go to find out more about you and your firm? We have a lot of private equity firms that listen here. We have a lot of large syndicators, things like that, and a lot of people that are confused. Where can they go to learn more from you or get in touch with you?
Yeah, you bet. It's at my website. It's my name, andrewbusch.com, and it's Bush spelled like the beer, not the president. So,
and we'll have that link in the show notes, everybody.
That's great. Yeah, I really appreciate it. And again, we have all of the research we produce is for free. As a matter of fact, one more thing I would offer too is we just created a webinar about all of the changes that are coming with the Trump administration. So you want to check that out as well. That's something that we just started to do.
Everybody go down and watch that. That's what I think a lot of people are wanting to know. We'll link that straight in and we'll get that out to everybody. So, hey, Andy, I don't want to take any more of your time. Thank you so much. I appreciate the conversation. Appreciate you getting out there and helping people understand. It's really, really important now.
All right, AJ, it was great. You've got very informed opinions on a lot of things. So it was a blast to be on with you.
Hey. Thanks, man. I appreciate it. We'll talk soon.
Okay.